right, today we are cracking open the Quantitative Investor's Toolbox. We're going to demystify the models, the mindset, and all the math that powers some of the most disciplined strategies on Wall Street. So let's kick things off by getting to the core problem that every single quant is trying to solve. In this quote, this really gets to the heart of it. Every single investment, no matter how much research you do, is a bet on an uncertain future. And that's exactly what quantitative investing is all about. It's a whole field built to answer one fundamental question. How do we make smarter bets in a world that's filled with noise and randomness? So when you're facing all that uncertainty, you've basically got two ways to go. On one side, you have the classic approach, storytelling, gut feelings, which, can feel really powerful, but they're often full of biases and they're not very consistent. And then you've got the quant approach. This is all about bringing structure, discipline, and the crystal clear language of probability into the mix. It's a huge shift from just going with your gut to building a framework you can actually test with data. Now, this entire approach isn't just about math. It's built on a very specific philosophy, a core set of beliefs that guides every single move. You can think of it as the quant's own version of the carpenter's rule. Measure twice, risk once. So let's break that philosophy down. First off, quants believe that even though markets look completely chaotic, there are real, discoverable patterns hiding in all that noise. Second, they see risk as something you can actually measure and manage, not just some vague, scary feeling. Third, and this one's crucial, they are humble about their tools. They know that every model is just a sketch of reality, and you have to understand where its limits are. And finally, they know that good data and solid assumptions will always beat a fancy, complicated equation. Garbage in, garbage out, right? Okay, so to put that philosophy into action, you need the right tools. And the very first set of tools isn't a computer program or a complex algorithm, it's a language. It's learning to speak the grammar of investing, which is really just the language of probability. Think about it. Before you can build a single model, you have to understand your raw materials. And in finance, that's data and randomness. Probability is the toolkit that lets an investor take all that market chaos and translate it into concepts you can actually measure and work with. It's all about taming randomness. So what are the key words in this language? Well, you've got things like expected value, which is just a way of calculating the most likely outcome of one of your bets. Then there's variance and covariance, which tell you how wild a stock's ride might be and how it tends to move when another stock moves. Correlation is absolutely key for diversification. It tells you how things move together. And then you have tail risk measures, which help you plan for those crazy once-in-a-decade events. These are the building blocks for understanding risk and reward. All right, so once you're fluent in the language of probability, it is time to bring out the heavy artillery. These are the tools that quants use to actually find patterns, test their ideas, and make really disciplined forecasts about what might happen next. And if there is one power tool that stands above all the others in that toolkit, it's regression analysis. Seriously, this thing is the absolute bedrock for so much of what quants do, from forecasting to building super sophisticated models. So what does it actually do? At its core, regression helps you answer a really simple but incredibly powerful question: how much does X affect Y? For instance, if interest rates go up by 1%, how much do we expect this particular stock's price to change? It's all about finding and measuring the relationships hidden in the data. But, of course, there's a catch. Markets aren't just a static picture that you can take a snapshot of. They're alive, they evolve, they're a sequence of events, and you need tools that can understand that flow of time. And that is exactly where time series analysis comes into play. These tools let quants model the market's behavior as it changes over time. This is how they build their forecasts, how they figure out if a price has gone so high it's likely to fall back to its average, and how they create economic outlooks based on cold, hard data, not just a gut feeling. Okay, so we've got these powerful analytical tools, which brings us to maybe the most critical job of any investor: managing risk. But here's the thing. For a quant, this isn't about avoiding risk. It's a craft. It's like a blacksmith working with fire at their forge. And this quote just nails the mindset, doesn't it? Risk isn't some ghost hiding in the closet that you should be afraid of. No, it's a fundamental part of the market. It's like heat to a blacksmith. It's a force that you have to understand, measure, and even shape to create something strong and durable. So how do they actually do it? Well, it's a very disciplined three-step process. First, they measure their potential losses using tools like value at risk, or VAR for short. Then they test for catastrophe. They throw all sorts of crazy what-if scenarios at their portfolio to see where it might break. And finally, they carefully allocate their defenses through something called risk budgeting, where they decide exactly how much risk they're willing to take in every single part of their strategy. All right, this is the moment we've been building up to. We've got the philosophy, we speak the language, we have the tools for modeling and for risk. Now what? Now we put it all together and actually build a portfolio. This is where the theory hits the pavement and becomes practice. You know how everyone, from your grandpa to your financial advisor, is always telling you to diversify? Well, this is where that vague piece of advice gets a serious upgrade. Portfolio construction turns that slogan into a razor-sharp, precise mathematical strategy for getting the best possible return for a given level of risk. And that strategy has gotten way more sophisticated over time. I mean, the early models were pretty simple. They focused on maybe one big thing, like how sensitive a stock was to the overall market. But modern quant portfolios, they are a whole different beast. They use these multi-factor models that pull in everything from big macroeconomic trends to the nitty-gritty financial details of a company, all to build a much stronger, more robust portfolio. And that brings us to our last section. And honestly, this might be the most important tool in the entire box. And it's not a formula, it's not a model, it's a principle. Because having all these powerful tools means you have an even bigger responsibility to use them with integrity. I mean, really think about it. You can have the most advanced models on the planet, the fastest computers, the cleanest data money can buy. But what good is any of that without a moral compass to guide how you use it? Because the power of quantitative analysis comes with some really serious traps. It is so easy to just torture the data until it confesses to anything you want it to say. That's called data mining. It's also tempting to overfit your model, where you build something that explains the past perfectly, but is completely useless for predicting the future. This is where intellectual honesty becomes everything. And I want to leave you with this final thought because it just says it all. At the end of the day, the goal of this entire toolbox isn't just to be smarter or more complex. The goal is to be more honest. Honest with ourselves about what we know, what we don't know, and the real risks we're taking. Because without that integrity, all the math in the world is just a faster, more efficient way to fool yourself.